Well, good afternoon, good morning, whatever it happens to be. Happy. That's what I feel like today. I look outside and it is drizzly. It's dark, not dark, but it's overcast and just raining. And it's typical for the Northwest winter. But I just read Brenda's post, and you're right. The reason for the season gives me happiness and joy. So Merry Christmas to everybody. Happy New Year to all of you coming up. Well, I won't talk to you again until after the New Year. Oh, let's see. My screen is not shared yet. Well, true, because I hadn't shared it quite yet, but let's do that. You know, it did not. Hang on a second here, because it didn't let me. Let's see. This will stop others from. Let's see if we. All right, give me some input now. Yeah, I'm in the. I've got my camera on, and it's kind of dark and dreary in here. I don't have too many lights on. It kind of reflects what's going on, but that's okay. Something just said, I've got a box up here that says installation failed, retry. I'm going to kill that and just to see what's going on. Wow. I can't hardly tell. I need to find out what you guys are seeing. That's probably not it. This is the PowerPoint that I want up. All right, well, tell you what, I'm going to change the let's do this, start from the beginning. Okay, all right. Does this look normal now? You're seeing the full slide. You're not seeing the support staff. Just tell me if we've got this back to normal. They say normal. Okay, good. All right. Well, then the first thing we do is we hit this little button and it goes to the disclaimer. And I remind you that we are not going to be giving you any specific advice on any specific trades, and that trading is risky and you need to be careful about everything you do. We are not giving you advice. We're giving you education and training, period. All right. Be notified. Read it and we'll move on. But anyway, gosh, I tell you guys, I love doing this. I love being able to chat with you, to teach, have the opportunity to share some things that are important to me. I understand the journey that you're on intimately, and salute you, applaud you for being on such a journey. It's not an easy thing, not an easy thing at all. But is it worthwhile? Absolutely, absolutely. And it never hurts to continue to get better. So that's what I hope that you're doing, is in a constant search to improve your skills. And by doing that, you will have opportunities to have a lot of specific training from folks like Rob and myself, and even Trip as it's showing up, which is amazing. I love to see that. Love to see that. So here's some of the things that are coming up as you look at the calendar. Please take advantage of everything that you can. Everything. Okay. All right, here we go. Next thing up, just a reminder of all the different sources that we have, and then a couple of promos that are for things that are coming up. Rob's got this set up for you guys that I've seen the advertisement several times. Just take advantage of everything that Rob puts up there. I always salute him because I know what it takes to put content up and have quality content in front of folks all the time. It's a huge effort, and I really applaud his efforts. It's awesome to see my dear friend and student and now fellow coach and trainer, Trip, being able to have an opportunity to help share some of the things that he has learned and the skills that he's acquired. And I just am totally thrilled with that. Good job, buddy. All right, for today's subject, I told you last month that we were going to continue on to candlesticks, and we are, but not today. I had something come up a couple days ago, and I thought, you know what? I was going through some files, and I ran across something. I said, you know what? This is something I've got to share. We haven't introduced this to you guys, but it is something that is absolutely imperative for you to understand. And so I want to go over this today with you, and then we'll pick up on candlesticks next month. Forgot my camera was on there. Had a little tickle on my nose. I had to sneeze there. All right. So we're going to talk about, I'm introducing it with a reference to a movie called Vantage Point. How many of you can recall ever seeing Vantage Point? And if you haven't, this is a great older movie to pick up. I'm waiting. No. Jennifer, watch this. Watch it. Anybody else? Who's seen Vantage Point? It's a fascinating movie. It's different than any other movie that I had ever seen. You can see that there's some all-star folks in there, Dennis Quaid and others, and Sigourney Weaver and Whitaker. Anyway, here's the premise for it. There was an assassination attempt made on a president of the United States who was visiting Spain to talk. And as the shots rang out and the president went down, the whole movie is nonstop action, because what they do is they show the movie and the setup for this incident that took place, which is the attempted assassination of a president. And the whole movie is rerunning the whole experience of the buildup and the shots fired, but through the eyes of 1, 2, 3, 4, 5, 6, 7 different people. So in other words, they show the movie through the eyes of Dennis Quaid, who was the Secret Service agent in charge of protecting the president. They show the movie through the eyes of Forrest Whitaker, who was an American tourist who happened to film it on his camera. And as they run the movie over and over, and essentially they play the movie 7 times, but from the perspective of different people. And it's fascinating to see how things, I mean, we see this play out sometimes in court cases and other situations where you hear one side of the story, and then somebody else comes in and gives a just as legitimate viewpoint, and you realize, holy cow, if I would have only seen it through that one perspective, I would have totally missed half the information. It wasn't exactly like the person who saw it, even though they experienced it firsthand. If you saw it from a different perspective, you got more. And if you saw it from 5 or 6 or 7 different perspectives, suddenly now you have the whole thing, right? So the point is, when we look at charting, when we look at data, when we try to make decisions, there is a real value in gaining perspective, a perspective that comes from looking at the same thing at different ways. I would give you the example of using technical indicators. Now, with 100 technical indicators or so out there, you can get overload. Absolutely. And there's a lot of redundancy and there's a lot of garbage. I'll just say it flat out, just garbage. That's not worth your time. But having 3 or 4 or 5 technical indicators to look at something gives you a better perspective than having 1 or none. Does that make sense? And so I want to show you something having to do with time value, gamma, delta, and your positioning with options. Which strike price do I take? How long do I want to hold this position? Where do I want to be in this position and why? There are some things that can help you make better decisions on positioning on options that I want to introduce to you today. That I think will be valuable. At least it will be something akin to that movie where you're going to see the same movement from different perspectives, and it'll give you a better feel of how to position yourself. All right, so hopefully that wasn't too crazy of an introduction, but let's see how we go. My first question is, let's look at this. Now, it says the effects of time, but I'm not going to give you much information to interpret it in terms of time. Let's just do this in this context. If you could ride this wave, and let's say this wave represents excitement, okay? So this wave represents excitement, and you can ride on this wave for 6 dots. You could go from number 4 to number 10. You could go from number 12 to number 18. Where would you get the most excitement if you were on this ride? If you could ride for 6 dots, tell me which 6 dots you would want to ride if the goal was excitement or thrill. Seven. Stephen says 7. That doesn't tell me anything. I want it from which dot to which? 6 dots, from 4 to 10, from 6 to 14, or 6 to 12, from 10 to 16. There we go. Steve says 7 to 13. Okay. And I get 6 to 14, 6 to 12, 8 to 14. All right. So now we're cooking. So what you're all saying is, in that steepest part of the curve, you're going to have the most excitement. And I agree. You know, that build up to climbing up the first level of a roller coaster, and you gets to the edge, and as it starts to go over, it starts to get exciting because your stomach goes, oh my gosh, and then you start to drop. And that's where the thrill comes in, as you're dropping down. And when you hit the bottom and it rolls out, then the thrill kind of dissipates, right? That's a principle that I want you to understand. It's a setup for where I want to go today. We're going to talk about gamma, delta, and time value, which would be theta, but we're going to talk about it just in terms of time, and we're going to look at that impacts through the eyes of gamma and delta. These are, I call them money curves, because depending on where you're at on a price move, which strike price you're at, how close you are to the being in the money, at the money, or out of the money, how many months out you've got on that time value, will depend, or will determine how much money you make on a specific move. Let's say the stock moves 4 points or 6 points, whatever it is. One option position is going to make X amount. Another option is going to make a lot more or a lot less. So picking a certain option strike price in the right part of a curve is going to determine how much money you make. Everybody kind of follow the setup. I don't want this to suddenly, when I start showing you graphs, I don't want it to suddenly go, wait a minute, what are you talking about? I want you to understand this picture. Look at those dollar signs and think about those dots. If you could ride 6 dots, what 6 dots would you ride if you were trying to maximize the excitement? Well, it's pretty obvious, the steepest part of the curve. If you could collect 4, let's do this. If you could collect 4 dollar signs, which ones would you collect? Now, you can't type in their numbers because they're not numbered. That would have been good. That would have been a good exercise to number these, wouldn't it? But where would you grab the 4 dollar signs? From the edges? Right in the middle, Stephanie says. Well, yeah. At the highest point, Jennifer says. In the middle, Helen says. Yeah. So the point is, I'm going to show you that it matters where you're at, where you choose your options based on what the stock is doing, and what it's doing and what it's likely to do is going to be determined by what the gamma and the delta is. And I'm going to show you the effects of that so that you can realize that it does make a difference. All right, here's a curve two curves that illustrate visually an option setup. If you look at the blue and I call it purple, okay? The blue represents calls. The purple represents puts. The red vertical line is where the stock is. The stock is at 164 right now. All right, the stock's at 164. The green line is showing the value of time. What do you mean? Well, you can see where they cross. The blue and the purple cross right where the red line is. The red line is the stock is at 164. 164 is called at the money, correct? That's where the stock is. So it's at the money. That's the term. The blue line, there's a solid and a dotted line. The solid line is what the actual price is at the money right now. The dotted line is the theoretical value. It's what's called, it's where the computer calculates that the cost of time should be. So if the cost of time, pardon me, is more than the theoretical value, what does that tell you? Anybody want to, let me throw that out and see if anybody can answer, because you can see for calls and puts, the actual value of the calls and the puts at the money is higher than the theoretical value. What might that mean? Anybody? What could that be hinting at? The green is showing you the dotted line is crossing where it should be. According to the computer, that's what the time value should be. The solid green line is showing you what it actually is. Okay, so Philip says overpriced. That is the term that we use. It's overpriced, but is it really? Is it really? It is only overpriced when you compare it to the theoretical value. But which is the right price? The theoretical price or the actual market price? Interesting answers. I'm going to go with Jennifer's answer. She said the market. Exactly. The market is always right. Whatever a buyer and a seller are willing to agree on, that's the correct price. Yeah, but according to the computer, it should only be this much. Who the heck cares? Well, but the computer says that this is, I don't care. If I'm trying to sell something and the price is higher than what the computer says, I'm happy. I'm fine with that. If I'm trying to buy something and the price is higher than the computer, I can be upset, but I can't change that. I can't run around and say, you guys can't charge this much because the computer says it should only be. It's the willing buyer, willing seller. Okay? And what you're seeing here happens all the time. It's just that when it's jumbled up in a wall or a matrix of columns and rows, all the different strike prices, all the numbers, it's hard to find it. Jennifer says it's like selling a house, what you want to sell and what you and the buyer agree to. Exactly. And that's what you're seeing here. This is an actual representation of a options quote page showing the actual price, the theoretical price. Okay. Can they be the same? Yeah, a lot of times they are the same. Sometimes they're wildly different. Sometimes the calls are way overpriced and the puts are fairly close to value. Really? Yeah. And each one of those things can mean something. Now, we're not going to go into the depths of that today. I mean, that's a whole nother subject of being able to interpret these discrepancies and what they are suggesting. That's not our subject matter today, but I'm showing you that it's legit. Okay. And it's interesting when you plot that. Let me ask you a couple questions. I just want to see if you can follow this chart. Calls are in the blue. When the stock is at 158, if the stock was at 158, okay, so these prices are not set up on the strike prices. So 160 would be a strike price. The 160 calls, are they in the money, at the money, or out of the money? Real quick. 160 calls, in, at, or out of the money? They are in the money, correct, because it's at 164, so the 165 would be the closest strike price. Let's say we have $1 strike prices, which is some stocks have $1 strike price. So we have a strike price at every dollar. So the 158s would be in the money by how much? Well, they'd be in the money by 4, 2 is 6, right? 4 and 2. So $6 in the money. Well, they're going to be more expensive. If you look over to the left, those are your option prices. So the farther you go in the money, the more expensive the options are. Makes perfect sense. You should all know that. But look at the purple chart. It swings the other way because it goes in the money by being higher. So the 168s are $4 in the money. They're more expensive. The 173s are more expensive because they're farther in the money. The 168 calls are less expensive because they are out of the money. Okay, everybody see that? So when you're looking at this, If the stock were to move to the upside, $4, it would go from 164 to 168. Well, if you look at the chart, it looks like the price would go down. It would not. Because if it goes to 168, what is at the money? 168. So the 168 would be in the same position 164 is now, which means the whole curve would slide up. Okay. So what you can see by looking at the blue curve is how fast or how much money you would make theoretically if the stock were to move right now, $4, and there was no change in the time value. You could see what a $4 move or a $5 move would make. For example, to go to 158, if the stock went up $5, your position at the money would be the same as where it is right now at 158, because that's $5 in the money. So you can literally see how much the stock would go up if it moved instantly and time value didn't change. Now, here's another reminder. At the money, how much intrinsic value is in the money? How much is intrinsic? If it is, it looks like it's $4 to me. So let's say it's $4 right now at the money. How much of that is time value? How much of that is intrinsic value or equity? If you have the $164 calls right now, how much of that value, that $4, is time value, and how much of it is intrinsic or equity? $4 equity, the rest is time value. Is that right? If you own a 164 call and it is at the money and it is going for $4, what is the value of time? You don't have any equity. You don't have any equity at 164. You're at the money. That's a par. If you were $4 in the money, you would have $4 of equity, and the rest would be time value. If I have the right to buy something for $4 different than it is right now, for $4 less than it is right now, I have $4 of equity. If it's going for $4, that's all I have is equity. If it's going for $5, I have how much time value? $1 of time. At the money, I have no equity. I have $4 of time value. All you're paying for at the money is time value. The time value disappears as you go out of the money and in the money. Okay? When you go out of the money, all you have is time. There's no equity. And so your time value disappears. As you go in the money, you get more and more equity, and the time value disappears. Okay? So let's go a little bit farther. Let's look at this curve right here. Now, this looks a little bit like that first one that I showed you, that S curve, but this is a bell curve. And this is showing the value of just about anything. We could say time value. Could this plot time value? Yes. Where is time value going to be the highest? Time value disappears as you stretch it out. Okay. Could this be delta? Let's look at delta. What is delta, by the way? Anybody give me a definition of delta? What is delta? Delta is how much your option changes with a $1 move of the stock. If the stock moves $1, how many pennies does your option move? If the stock moved $1 and your option moved $1, that means your delta is 100. For every dollar move, you get $1 of value. Is that going to be in the money or out of the money? Let's see if you guys can follow this. This gets a little bit heady, but it's important. If the stock moves $1 and your option moves $1, are you in the money or out of the money? You are in the money, deep in the money. There's no time value. It's just all equity. If the stock moves $1 and your option only goes up 20 cents, are you in the money or out of the money? You are OTM, out of the money. Okay. So if you looked at this and you look at this as delta, the delta is going to increase as you get closer to the money, and it will continue to increase as you get in the money until you get to 0. Delta goes from 0 to 100. Okay. Let me show you something right here. Now, this will get your eyes to bug out. All right. But I want you to see something by isolating and trying to just look at one thing at a time. So let's look at one curve only, which would be in the top left. What you're seeing in the green and the red here is delta. The red would be the delta for calls. And you can see that the delta gets higher and higher and higher and higher and goes all the way up. It's approaching 80, and it would keep on going all the way to 100 if it kept going, right? And it would go all the way to 0 if it kept going to the right. Where is delta at 50%? It's at the money. Delta is typically about 50% at the money, typically. Okay. And what you see here in the dotted line below it is gamma. Gamma. Oh my gosh, another term. This is going to be confusing. Not really, because gamma is kind of like your speedometer. Gamma shows you how fast the delta is changing. Okay, now please just try to relax and don't let this get too far ahead of you. It's important you understand this concept. We are looking at the impact of time value and the impact of option pricing from different perspectives. The delta is showing us how fast our option will change, how much our option will change with each movement of the stock. Okay. And when the line is straight like that, it pretty much doesn't matter if you're in the money, at the money, or out of the money. Each move of the stock is going to produce the same move in the delta. So let's say the delta is going up 4% or 3% with each move, with each strike price. If you're in the money, at the money, or out of the money, the delta is going to give you an additional 3 cents or 4 cents with each move. Can you follow that? If it's a straight line, each change in the strike price is going to give you the same number of pennies in your option. Your penny, let's say if it went up 4 cents with each strike price, each one of those vertical lines would give you a 4-cent increase in your option as the stock moves. That's what that straight line in the delta would mean. Is it the same in the puts? Pretty much. Pretty much. So what you're looking at is for puts and calls, there's going to be very little change in the difference or the gain that you would get or the loss you would have on your option price by moving one strike price. Look at that dotted line. You see how flat it is? That dotted line is called gamma, and it says, how fast does the delta change? If there is any change in the delta, how fast does it change? And you can see it swells a little bit as you get to the money and then go out of the money, either direction, calls or puts. So that means as you go from out of the money to in the money, or in the money to at the money, as you're crossing through the middle point there, you're going to pick up a little more money a little faster, a little bit. So your delta will pick up and you'll make a little more money on each strike price move until you get to the at the money position. And once you go past that, either way, the amount that you're getting goes down a little bit. So let's say as you're approaching the money, you get 3 cents for each strike price. So as you're coming towards the middle point, you're getting 3 cents, 3 cents, 3.5 cents, 4 cents, 4.5 cents, back to 3.5, back to 3. You see? There's just very, very slight change in the speed or the acceleration of your profits or your losses if it's going against you. If you're losing money on the option, then there's a very slight difference. In other words, it doesn't matter where you're at the money, or out of the money. If the stock moves, it's going to cost you or make money about the same. All right. Everybody or anybody, tell me whether or not you're kind of follow that explanation. I wish I could illustrate it by hand a little better, but if you see that dotted line is a flat curve or a very flat curve, that means no matter where you are with your calls or puts, in the money, at the money, or out of the money, when it moves either for you or against you, the difference on each strike price is going to be about the same. Please, somebody tell me that you follow that. I know that's a mouthful, but it's a principle that I think is important for you to understand, because what happens, guys, well, let me ask you this question. How many of you have ever had a stock move and you've been confused by what the option price did? Who's had that experience where the stock moved and you thought that it would do something and it did something else? Yeah, so everybody's jumping and go, yeah. Well, this is why. Guys, look at the stock or the top right chart. Look at the top right. Does it look like the top left? No, it doesn't. But they're both absolute representations of option pricing. This one, the stock is at 164. So this is similar to the one that we looked at. Look at the shape of the red line and the green line, which is the delta for the calls and the delta for the puts. It doesn't look like the one in the top left because it isn't. The pricing's different. Look at the dotted line. Holy cow, that looks like the roller coaster hill, right? That's the one that I showed you earlier. What happens here? If you are moving between one strike price and another strike price, the delta is going to change differently. It's not going to be linear like it was in the top left. You're going to have a difference in how much money you make with each strike price move. How fast will that change? How fast will that number? So in other words, as you move, you might be getting 4 cents, 6 cents, 9 cents, 12 cents, 18 cents with each strike price move. Well, I like that. As opposed to getting 3, 3, 3 1/4, 3 1/2, 3 3/4, 4, back down to 3 3/4, back down to 3 1/2, right? As opposed to, I made 6 cents on the last move, I made 12 cents on the next move, I made 19 cents on the next move, and I made 80 cents on the third move or the fourth move. That's exciting. That's why I ask you, where do you want to ride the 6 dots? Where do you want to ride the 6 dots? If you're looking for excitement, and in this case, if excitement is money, you want to ride it through the middle. Where do you want to grab the money? You want to grab it through the middle. Where could you grab the most money? By starting in the middle and going down to the left or down to the right, or starting on either side of the middle? Sometimes it depends on the curve, but you get the idea, don't you? Where are you going to get the most money in an option trade? It's by riding across the middle. Guys, I submit to you that even on the chart on the top left, which is the dullest, boring chart that you can have in terms of option pricing, low volatility, you will still make the most money on any option trade by riding it from out of the money across the middle to the in the money position. If you're going to ride 6 strike prices, you will make the most money by starting out of the money. Now, does that fly in the face of some people's advice of, oh, yeah, you always start, then you've got intrinsic value. And if the stock goes against you, at least you've still got some intrinsic value. Okay, I get that argument, but you don't go into it assuming it's going to go against you. If you go into it assuming that this looks like it could, there's a reason to go into this because there's a good probability we make money on it. Okay, well, then you set it up that way. As far as your expectations, in terms of the upside, right? Well, where would you have the strongest upside? Guys, I'm submitting this, that you grasp this concept, because you're not going to have these charts. These charts are to show you. But the concept I want you to grasp is, where do you get the biggest bang for the buck? Where do you get the biggest response out of your option? And I'm telling you, the most profitable option position by far on any given move, you pick a stock and you say, we're going to ride this for $10. There's no $10 move that will outperform starting at the right spot, but starting out of the money and riding it across into the money. Is that clear? And is that something new? I would expect that that's new to some of you. Which strike price will always win? All things equal, if you're going to have a 2-strike price move, 10-point move on a particular stock, if it moves in your favor, which option will always outperform? Gwen says, very clear, very new, very scary to think about. I will try it on a simulated trade. That's great. Try it. And compare. Guys, if you take a simulated trade, if you do a sim trade, and I would suggest watch a stock, but follow at least 3 or 4 different option prices. Start one in the money, start one out of the money, start one way out of the money, start one way in the money, start one at the money. And then what the stock does, follow the change in the options and see which one performs the best. That's kind of a simple thing. I could have said that at the beginning and said, we're done. But I wanted you to see that if you look at this from different perspectives, you can see something that was always there, but you didn't see it because you didn't know how to look for it. You'd never looked at it that way. Okay, you see the one in the top middle? It's starting to shape. You can start to get a little bit of a bend in the call and the put, the green and the red lines, and you can see a definite rise in that dotted line, which is the gamma. And the gamma tells you how fast your delta is changing. If your delta is not changing, you've got the top left chart. It's the same. The top right chart, it's a huge difference. The delta changes very quickly, but there's a place and there's an area where it changes the fastest in your favor. That would be the one where you'd make the most money. And it's going up over that hump and down the other side, about equal distance. Start, if you've got a 10-point move, you want to start 5 points on either side of that, the money, if it's going to happen. Now, what if it doesn't happen for a while? Well, the time value, that point where it crosses, is going to sink because time value is dripping out every day, typically. Okay. Let's go to the bottom left chart. What do you notice about the bottom left chart? Well, you can see it run out farther on the left side, and that's just because more strike prices are visible over there. But you can see the farther it goes, the more it is changing. The one in the bottom middle looks very much like the top right. It's just at a whole different price point. We're up there at $250 on the at the money position on that one. But you can see that the shape is about the same. It's actually more. The shape is more dramatic. Then you look at the bottom right, and that one is, you can see it looks like the top left on purpose, but I deliberately ran it out farther to one side just so that you can see that even if it's linear, as it goes over time, it'll start to bend. It'll start to bend. But, you know, that's irrelevant in terms of where you would be taking your strike prices. But it just wants you to show, I just want to show you how this actually works. It's fascinating. And you can sometimes, as I said, get things that are skewed left or right. In other words, it'll be different for the calls than different to than the puts, or different to the lower strike prices and different to the higher strike prices. All those things are interesting, but they're a reflection of how the market perceives the value of the stock. Now, this is an illustration that I think will help, because this has to do with time, the impacts of time, and what we perceive as volatility. When we see volatility, we see prices that are moving faster than they were before, or slower than they were before. If things get more volatile, price movement is faster. And you will start to see more discrepancy between the theoretical value and the actual market value, because the market value is real time right now. Theoretical takes in consideration what has happened, and it keeps calculating, recalculating. So it's always going to be behind the actual price. And sometimes they'll be the same because there's been very little change. So they're going to catch up with each other. But when the market starts to get more volatile, the theoretical value cannot keep up with the market value. It just can't, because it's trying to recalibrate all of the previous data. So it has to be slower. So when volatility increases, you'll see a separation between the market and the theoretical price. I hope that makes sense. When you have a wave moving through deep water from the left here, it doesn't hardly, you can't even see it. The wave action, the energy of the wave may be moving sometimes at hundreds of miles an hour. Imagine a wave going at 200 miles an hour and you can't even see it out because you're out on the ocean. You can't. If the water is deep, the shock wave moves laterally, horizontally through the water. As the bottom of the ocean moves up, that energy of that lateral movement starts to be compressed into a tighter space. And so the first thing you start to see is wave crowding over on the left. You'll start to see the surface of the water start to get waves. They're just swells. They're just small swells that will start as you get closer to land. The closer you get to land, the height of those swells increases, and the energy is distributed into fewer of those swells, but they're higher. It's the same amount of energy. And as it gets closer to the land and the beach, the bottom of the ocean comes up towards a beach, it forces that energy again into less waves or less swells, but they're higher because they're accumulation of more. And so it rises up and it starts to crash onto the beach. Okay. What you are seeing here is, it looks like waves, and it reflects similar activity, because the top right and the bottom middle are showing you a wave about to crash on the beach. This is a wave energy that has been compressed into a spot where the volatility of the market is operating in where it's running out of time. As it's starting to run out of time, the probabilities of a big move one way or the other becomes scary to people in positions, because it might go against them, or it maybe is going against them, and people get volatile. They get a little bit more panicked, and their willingness to pay different prices increases. And so price movement starts to move away from the theoretical value, and it gets hard to follow. But that's what you're seeing. But that's exciting, because if you're in an option that's moving in direction, you're going to get a huge move if you're in the right spot. If you're in the right spot, you're going to catch a wave, and it'll be a big wave that'll pay off big. If you pick the wrong spot in a wave, you might have a big wave, but you get very little of it because you're on the outside of the wave, and you don't get very much excitement. But if you catch the wave right, you get the biggest excitement for the shortest amount of move. And what you're seeing is the interaction of the market and the cost of time. Okay? Now listen to me. No matter how volatile the market is, intrinsic value or equity doesn't ever change. If you're $4 in the money, you're $4 in the money. The stock's really volatile. If you're $4 in the money, you're $4 in the money. If your $4 in the money option is worth $8 and somebody else's $4 in the money position is worth $15, you're still $4 in the money. Intrinsic value does not change. The thing that changes is time value, guys, and then the cost of the options and the benefit to you of the option. It's the changes in time value, not just intrinsic value. The stock is going deeper in the money. Yes, it is. But your option is going up or going down. It's going against you by two components. The intrinsic value changes and the cost of time changes. The more volatile a movement, when you're talking about the top right illustration, that volatility is not in the intrinsic value, it's in the cost of time. That's where the big bang comes from. And so what we're looking at is two ways to measure whether or not the time is getting more exciting, more valuable, or less exciting and less valuable. And we look at it through the delta curve, and we look at it through the gamma curve. The gamma tells us how fast the delta is changing. The delta is telling us how much we're making with each strike price move. Every time the stock moves, are we making money? If so, how much? What about the next strike? How much? And if it's the same, then you have a flat curve. But if you make 20 cents on one move and 40 cents on the next move, you're writing something that looks like the top right. If you had the ability to see what it looks like, you could anticipate, if I get a move on this stock, this is going to work out really good. Hence, when you have a stock move and you don't understand what the option did, it's because you didn't see ahead of time how it was set up. Now, I'm going to give you a clue on what you can do on an option chart on how to figure that out, or at least to get a clue. Okay, how to get a clue. But it's a principle that you need to understand, because it explains why the option did what it did. Now, if you don't care, then this is just an academic exercise, and that's fine. It was interesting, fun charts, lots of colors, red and green, Christmas colors, whatever, right? But if you want to have an idea, when the stock moves big in your favor and the option doesn't move nearly as much as you thought it was going to, it's because the curve looked like the top right. And when something moves more than you thought, or you're really happy with the big move, it's because it was set up more like the top right versus the top left or the bottom middle. Those are the ones that are going to give you the big payoffs. All right. Now, I don't know, did the wave analogy help? Because what you're seeing is that as that builds up and builds a big wave that crashes on the beach, that's what's happening with the options. The time value is getting accelerated because of volatility. Okay, so take a look at this again. Your gamma is that purple dotted line. The reddish colored one is the calls. The green one is the puts. And that red line down in the middle is the actual stock price. So that's where it's sitting right now. And your delta, you can see, goes to 100 and 0. What about the gamma? So the gamma, getting up there around 60% at the money, that's high. That's where you're going to have these big, high volatility moves. And the gamma is simply saying, this is what I'm showing. I'm showing how fast you accelerate. When you step on the gas and you count to 5, you are going to accelerate like crazy over those 5 seconds. As opposed to that chart that was on the top left that had the flat gamma curve, you step on the gas and the engine goes, what? I just stepped on the gas. Really? Oh, sorry. Yeah, we'll get to it. We're kind of busy right now. And your car just barely accelerates, right? You're driving a 2-cylinder or a 3-cylinder. Gosh, guys, I went to Las Vegas a couple months ago, and they tried to rent a car to me. It was a great deal on a car. Okay, it was just kind of an economy, which was fine because I only needed it for a day. And I thought, well, this is fine. But I had to go. No, actually, this was when I got to California. That's what it was. And I knew what the freeway was like where I was going. There was some long uphill climbs up into the hills. I got in this car, and you don't really know in the parking garage because you can't do much. I got out of the parking garage, stepped on the gas, and the car just kind of went, huh? I went, what the heck? I turned around, went right back in. I said, what's wrong with this car? And they said, well, nothing. It's just a 3-cylinder. Do they make 3 cylinders? Yeah, they make 3 cylinders. They're real economical. I said, this won't go on the freeway. I know, because I've driven that road that climbs into the hills where I'm going. I said, this would never work. I'd be going 30 miles an hour, right? And that's what happens when your gamma curve is flat. You step on the gas and it just kind of, huh? Oh, really? Well, no, we don't do that. We'll get you there, but it's going to take an hour, right? That's what a flat gamma curve will give you. It will give you very low results when the stock moves in your favor. This is a gamma curve that is going to give you high results. Okay? So again, when we look at these individual charts, you can see that the one on the left, you should be able to see by now that that is going to make money if the stock moves in your favor. It's just going to bore you to death. It will be a slow burn, but it'll be consistent because there's no volatility. The one on the right, that will be exciting. But where are you going to get the biggest bang for the buck? Where will you get the highest returns? The higher the gamma is, the faster the delta is changing. And so if you looked on the red line, where would you want to ride the red line? It looks just like the first chart I showed you, and it's right through the middle. From the bottom on the right to the left, you'd want to ride it from the right to the left. How about the put curve? You'd want to ride it from the left to the right across the middle. Philip says, so does that mean buy options when volatility is low and sell options when volatility is high? No, it doesn't mean that. It doesn't mean that. If the volatility is high, why would you not want to buy them? Because when you buy an option that has high volatility, if the gamma curve is like that, if you buy it slightly out of the money and ride it to slightly in the money, your option is going to make money faster than at any other time in that option's life. Okay. If you look at if you imagine the purple line, okay, the one that looks like the hill right there, I'm top right. Look at the top right here. If you can imagine that, the higher that dotted line is, the faster your option is accelerating, the faster your option is changing to your favor. If you're in a call, the higher that dotted purple line is, the more money you're making with each move of the stock. So if you could take your option and spend the whole time right at the top of that dotted line, you would be accelerating that option price with every move in your favor as fast as it could possibly accelerate. It would be going faster and faster and faster, more and more money each move. But you see, once you get to the at-the-money position, the impact of time starts to impact, and so the speed at which your options are changing slows down. So your biggest bang for the buck is that chart with the dollar signs, right in the middle. Take as many of the big dollar signs as you can. You want the one in the middle, and you want one or two on each side of it. That's where you're going to make the most money. Does that make sense? Please, somebody tell me that the lights are going on. Guys, looking at this, where do you want to grab? If you could grab $3 signs, I'm making this so easy. If you could grab 3 of them, which 3 would you want? What you're seeing is this, the top right. Picture that curve as dollar signs. Which $3 do you want? And if you don't say the middle, I failed. I want the 3 biggest ones. Well, where are they? Right there. In this case, it would be 1 strike in the money to 1 strike out of the money. Ride the red curve from 1 strike out of the money to 1 strike in the money. Ride the green curve from 1 strike out of the money to 1 strike in the money. That's left to right. Oh, I wish I could see your faces, or at least have you raise your hands, for crying out loud. Is this making sense? Do you see why it makes a difference which strike price you choose and what the option prices are before you jump into it? What the gamma is. This is what you're looking at. Picture that's the move. And if you count those, you'd have 1, 2, 3, 4, 5. That's a 5 strike or a 5-point move, 5 lines. If you ride a call or a put across those 5 points and you put it squarely over the middle there, you will make the most money that you can make on any other strike price selection. Doesn't matter if it goes up or down, the change in the value of the option is going to be the strongest. Whoa. I mean, if it goes against me, it'll be that strong? Yes. Yes. The value of the option will drop as fast as it increases. So you take the position in the direction it looks like it's going to go, and you set your stop to where if it turns on you, you get out because it's going to turn fast. Guys, there's no free lunch, right? There's no magic here, but there is definitely power in understanding what can happen, because then you can recognize and explain what's going on with your options. Steve says, so 178.5, 178.5 is at the money. I wouldn't want to take that position. If I was doing calls, I would start. So Steve, if you look at this and each one of those lines, let's call each one of those lines a strike price. Okay, they're $2.50, or they're what they are. They're $2 moves. So let's say we have $2 strikes. If you rode it from $2 out of the money to $2 in the money, that would be your fastest gain of profit. Now, would you jump out if it's going in the money? No, I'd still keep going, but I would recognize that as it goes deeper in the money, I'm going to be making a little bit less with each one of the moves. I'll be making more money with each strike price move, no question. But the rate of increase in what I'm making slows down. Okay, it slows down. So Gwen, 176 would be a starting point for a put. If you're going to ride a put, you'd start at 176. If you're going to ride a call, you would start at 180 or 182, 182.5. That makes sense? So it depends on if you're taking a call position or a put position. All you got to do is look at the curve for the calls, which is the red one, and look for the put curve, which is green. And if you ride that positively, where would you want to ride it? You want to ride it where the gamma is the strongest, which means I'm making more and more money with each strike move. When the gamma turns over, does it mean I'm losing money? No, it's not negative. It's just that the rate of increase on each one slows down. I'm still making more money as it goes deeper in the money, but I'm making it slower and slower and slower and slower. Making less sounds like it's a negative thing. No, you're making money. You're just not making it as fast once you cross over and go in the money. And that gamma curve shows you how fast you are increasing profits with each strike. How fast am I increasing profits with each strike? So let's illustrate what I just said. I believe in repetition, repetition, repetition. So now we'll illustrate. The sweet spot. When you look at calls, you've got a box to the top left and a box to the bottom right. That is your least profitable position to take on those call options. If you wrote a call option for that part of the curve, either the bottom right or the top left, it would be the least profitable time to own a call. It would be the least profitable area to own a call. Helen says, I've noticed that open interest is larger out of the money. You know what? Sometimes, not always, but it can be. And that's a whole nother subject, Helen, that it's fascinating because oh, I'm not going to get into it. No, that's tempting, but I'm not going to go there. The sweet spot. I'm showing you the happy place. If you're going to ride that call right there, and we're only showing the call option right here. If you're going to ride that call, that little smiley face is where you're going to get the biggest bang for the buck. Okay. Helen, what I was going to say is I became very, very good, very accomplished. Rob has seen this before, where I would literally say, show me an options chart. Don't show me the stock chart. Pick any stock, show me the option chart, and I could look at the chart at the options, looking at the pricing, the open interest, the gamma, the deltas. I could look at that and tell you, because it would tell me where the stock is. So I knew what at the money was, but I could tell you where support and resistance were. And then I would write that down in front of the whole class. Then we'd pull up the stock chart and we would look where the next support and the next obvious support and resistance levels were. And I never failed. I never failed. And it wasn't because I was magic. It's just that the way the traders, if it's a well-traded stock, okay, it can't be a dog, but if it's a well-traded stock where there's an active options trade going on it, you can tell where people believe support and resistance is. And it has a historical implication. If they've had a recent support at a certain level or a recent resistance level, you can see it in the option charts. They literally lay down clues. So it was just fun to do, just to show that the information's in there. It just depends on what you're looking at and if you can interpret it. You know, you look at it, but that's just interesting. And that literally is the case because I did it for years. You just look at the options chart and I can tell you where support and resistance without ever looking at a chart, because they leave clues. And what I'm saying here on this picture, what part of the curve do you want to ride? Guys, you can ride any part of the curve. You can start way out of the money and the stock moves in your favor. You're going to make money for sure. You start deep in the money and it moves in your favor. You're going to make money. But if you're interested in making the most amount of money on a particular move, you start out and finish in. Now, if the stock showed you that the likely move between the next, where it's at and the next resistance or the next support level, let's say the next resistance level to the upside, and that was about a 10-point move. Okay, so you're looking to ride at 10 points. Well, where's your sweet spot? It's 5 points out to 5 points in. That makes sense to everybody? Because the next question that off of this chart should be, well, but which strike prices should I use? Well, how many points do you expect it to move? What does it look like it's going to do? Well, it looks like it'll have a 20-point move. Okay, great. Then you start 10 out and you finish 10 in. Oh, well, it only looks like it's going to do about $5 or $6 move. Start 3 out, finish 3 in, or as close to that as you can. Okay. So you look at the anticipated move and you split it, which is what Jennifer just said, and you try to go slightly out to slightly in, as close as you can. I mean, it's going to be oftentimes where you can't do it exact, but it gives you the idea. All right. Okay. This makes sense, guys? The gamma is like an accelerator. It tells you how fast you're accelerating, how fast your delta is increasing or decreasing. All right. And this is my last slide. We're out of time, but I hope you guys got something out of this. I know it's a little heady, but what it does is it helps you understand, number one, like I said, why did the option not do what it should have done? I mean, the stock moved this much. I should have got this much on my option. Why didn't it do that? Or, whoa, how come I got so much that time? Okay. All right. Here, I'm just showing you that positioning makes a difference. It's just an example to show you. For example, the one on the left, you've got a 21 gamma on the right side, 21 gamma on the left, and it's a little bit higher in the middle. So you're going to get that little rise through there. Over on the left side, if you started in a different position, the gamma is going to be at 14 and 25 on the other side. Well, it just makes a difference. You're going to get you're going to get a piece of pie, but it'll be a bigger piece of pie or a smaller piece of pie. All right. Jennifer says, how do we pull up options price charts instead of just stock charts? Well, when you pull up your options, when you select your options, it pulls up a whole matrix. And because I didn't get a chance to show you that, we ran out of time. Next time, we're going to be talking about candles. Like I said, we'll follow through. But I'm going to make a note here, and I'll pull up a chart, and I'll show you. I'll pull up an options chart and let you see how to read the delta and the gamma on there to where you can visualize this chart just by looking at the numbers. Okay. All right, guys, God bless. Merry Christmas. Happy New Year. Happy whatever you're celebrating. I hope you're with family. I hope you're safe in your travels. And I hope you have an awesome finish to this year and a great start to the next one. God bless. See you later.